Maverick. Noun, unusual person. A visionary, leader, go-getter, an independent thinker. They see the vision for their life and pull that future towards them with an unyielding belief that things can and must be better. They achieve what most won't. Innovative, influential, daring, and direct, with a remarkably high tolerance for taking calculated risk. A foe to the status quo. This is Passive Real Estate Investing with Mavericks. Your host, Neil Timmins, has been involved with over $300 million in real estate transactions. He's a published author, commercial property investor, and real estate syndicator. This show is for those who want to learn how to earn passive income through real estate investing. Now, here's your host, Neil Timmins.
It's another Freedom Financial Friday. I've got Ava Bouwkamp here with me, and you're going to get to uncover today, why would you want to invest in industrial real estate?
Hey Mavericks, this is Ava Bouwkamp, and this episode of Passive Real Estate Investing with Mavericks is brought to you by Legacy Impact Investors. We are an industrial investment firm located in cash flow country, the Midwest. We strive to shield off risk and beat inflation, all while producing predictable cash flow. We curate real estate investment opportunities for busy professionals and other real estate investors seeking passive income. To learn more about what we do and connect with me, go to www.legacyimpactinvestors.com.
During this episode, discover why invest in industrial real estate. Now, for those of you who are new, I'm your host, Neil Timmins. I love passive income from real estate. Now, I've got Ava Bouwkamp here with me. It's a Freedom Financial Friday. But before I bring her on, I want to make a request. If you like what you hear, give us a thumbs up. And be certain to subscribe to the show. Never miss a valuable episode. If you love what you hear, give us a written review. Plus, be sure to look at the description of the episode. We packed it with thousands of dollars in free resources. It's Freedom Financial Friday. I've got Ava Bouwkamp here with me. And we're going to be talking about why invest in industrial real estate. Ava, how are you?
I'm doing well. How are you?
Good. I'm doing great. Thanks. Good to have you here.
Absolutely. So today we are going to be talking about industrial real estate, which I know may not be on top of everyone's radar as an investment asset class. I think we all hear lots and lots about single family, about BRRRR, about multifamily. Multifamily is something that has been all over the headlines recently with rising rent rates, but industrial real estate it slides under everyone's radar a little bit. So we wanted to take some time to talk about why industrial real estate might be a asset class that you should be paying attention to as a passive investor. So, Neil, do you have any opening thoughts for us about industrial properties?
I think you hit it right on the head. You know, all of us have interacted with apartments in some fashion or another. Either we lived in them, we've been around them in one capacity or another. Retail is an asset class. You know, we've all been to Subway and we've all gotten a haircut. And so a lot of us interact with multiple asset classes. But industrial, for most people, they don't ever think about it. It's kind of out of sight, out of mind, if you will. And so these are going to be fun. I know we've got some multiple factors about why specifically industrial real estate. And so let's run down them. What's the number one on your list?
First one on my list is stable income. So for an industrial property, you've got someone in that building who might often be operating their business out of that building. And so they're going to be in a longer term lease length, sometimes 5, 7, 10, even longer. And within that lease, you're going to have regularly scheduled raises to those rents, usually on an annual basis. And so that gives us a great ability to predict stable income for a longer time horizon than something like multifamily, where you have someone turning over on an annual, maybe they're month to month. And so there's a lot more fluctuation in terms of what your actual rental income is going to be on an ongoing basis.
You're absolutely right. I love long leases, the ability for us to be able to predict what's the rent going to be in 5 or 10 or 15 years from now. And oftentimes these businesses are signing that long-term lease because they want stability in their business. They want predictability in their business. They want to know that they have a space and exactly to be able to budget. What are they going to pay for that period of time? And so for us, it allows us to predict and have a really good understanding of where the rents are going to be versus the ebbs and flows associated with let's call it multifamily, for example. And that doesn't necessarily mean just the rent, but it means the constant turn of people and the wear and tear on the units itself.
Yeah. And all of those turnover time, all of those maintenance and repairs have additional costs associated with them. And like I mentioned, those regularly scheduled increases for those longer term leases help us also to keep pace with inflation. So it's not something where you're getting locked into a 10-year lease and suddenly your lease rate is staying the same in 2010 as it will be in 2020. No, we make sure we include regularly scheduled raises to those rents so that, in a sense, we really can keep pace with inflation.
Yep, you're absolutely right. What's next on the list?
I've got low vacancy rate. I think you might be able to speak to this one really well.
Low vacancy rate. If you think about, there's a couple of things, but certainly a single tenant property, which a number of industrial properties are single tenant, one tenant. It might be 10, it might be 100,000, it might be 200,000 square feet. But you've got one tenant operating their business out of that. And again, going back to the first one, is they're signing very long leases, 5, 10 years, 15 years. And so exactly, it's either all or none. Exactly how far out they have planned and have committed to contractually to occupy that space. Secondly, if it's a multi-tenant property, so a number of industrial properties or let's call flex, kind of industrial adjacent properties. Those properties often have very low vacancy. And in many markets today, certainly under 5%, in many markets under 2% vacancy rate. Because again, they sign very long leases and they're operating their business. So unlike a person who would get married and vacate their apartment to go buy a house, businesses and those who operate them are looking for longevity. This is their livelihood. And so they tend to stay in these properties an extended period of time.
Yeah. I'm going to anticipate someone's question. And you said for a single tenant property, it's either all or nothing. So as a operator of an industrial property, how do you mitigate that risk of your cash flow going from what it was on a monthly basis to that tenant, if they eventually move out, now we're at zero. How do you handle that kind of situation to make sure that risk is mitigated?
Two things. One is buying the correct property on the way in. There are physical features of the property that we're looking for in every single property when we buy it. But what's the old saying? You marry the property, you date the tenant. So sooner or later, say over the course of, make up a number, right? 10, 20, 30, 50 years, the tenant will leave. And so you buy the right property so that it's in demand. There's regular demand for what you have. And the second thing is you make sure that the notice for that tenant in which they have to provide us to vacate the property is long. So in many cases, I'm looking for 6 months to a year that they have to notify us in advance to vacate the property, giving us, i.e., 6 months to a year to market the property to find another tenant to backfill that space. We want to make sure we buy plenty of time. No surprises.
Yep, that's great. Okay, so our third factor of why industrial real estate have a little bit more urgency, they're a little bit more recent. So I have two global factors that have impacted demand for industrial real estate, one being the COVID pandemic, and tied in conjunction with that is this recent demand for U.S. companies to reshore or onshore their operations because of these disruptions to global supply chains. So can you speak a little bit to those global factors that have grown the demand dramatically for industrial buildings?
So the pandemic had us all doing the same thing, staying home and shopping online, which means all those things online have to get put someplace. And that largely means giant warehouses so that we can have it ordered and then to our house in like an hour. Right.
Yes.
Gone are the days of 2 days shipping with Amazon. We all want it yesterday. And so everything's moving faster and faster, our ability to get something when we order it. And that means space. And so increased demand for that space, not just Amazon. Obviously, everybody thinks of Amazon first, but tons of things are getting sold online. Amazon's just the biggest player, but there's a whole bunch of other things that get done online as a result of the pandemic, and our shopping behaviors have changed forever as a result of that. Yeah. The second one, as you said, also kind of as a result of the pandemic, what we found out is the supply chain is largely broken, is our ability for, just-in-time manufacturing to get everything over from principally China and bring it through the port and get it across, like everything. And there are all sorts of weird things, if you can imagine all the things that just shot up in price like crazy through the pandemic, a lot of that just are items you could not get because they're overseas. And so what we're seeing is a reshoring or an onshoring. Use those words simultaneously. And people are coming back to this country. Manufacturing is coming back to this country, which means increased space demand for what's transpiring here.
Absolutely. Great. So my next up at bat is diversification. So let's talk a little bit about why industrial real estate provides a diversification benefit to those who invest in it as an asset class.
Well, you do a couple things when you invest specifically in industrial as an asset class. When it comes to diversification, you get away from, let's counter that with the stock market, for example. You get away from the ups and downs and all the things that may transpire in any given open liquid market, which is radical ups and radical downs at times. There's no doubt investing in real estate is inefficient. There's been a number of studies done. Harvard's done a number of them, among other people, that shows properly placed investments in the inefficient marketplaces and illiquid marketplaces. More specifically, you can end up with a rate of return that far exceeds that of a stock market. That efficiency and the liquidity in the stock market does not necessarily translate into increased rates of return. It translates into the speed in which you can convert an investment into dollars. What
do you mean by efficiency? You're talking about stock market. I just want to draw that out for someone who might not be familiar with that as an economic term.
Efficiency specifically as it relates to us in the real estate market is that we can buy properties because the market is not efficient, meaning the stock market's highly efficient. All things are known at all times. Anybody can transact at any given time on any given stock. Security, for example. In real estate is not the case. Oftentimes when a property is brought to market, it's oftentimes in today's market, it's brought up through a real estate broker who then provides some pricing methodology and input to the seller. And then that broker oftentimes calls 1 to 5 people in their inner circle and transacts on that property. That is not an efficient market. Right. In fact, it's highly inefficient from that standpoint. And there may be items and information known to a buyer or buyers that allow them to execute and capitalize on that transaction that may not be known to all parties, specifically may not be known to the seller.
Yep. I think maybe a tangible example of that would just be local buyer knowledge. Maybe they know that up the street a development is coming, and so it's a piece of ground or a property that may not be worth as much right now, but maybe 20 years down the line, it would be something that would be of greater value than it is today. And that is not knowledge that may be known by people in that market, and certainly not by people, 2,000 miles away in another market.
Yeah, there's no doubt about that. Filling that knowledge gap and having an understanding of what you can execute on, how you can execute on it, it is, in comparison to a seller and or the broker, for example, you can certainly capitalize in a large way.
Yeah, great. Awesome. So I just actually inadvertently touched on my next point, which is the ability for industrial buildings to appreciate in value over time. So talk a little bit about appreciation potential. And then also I want you to touch on scarcity of existing industrial properties and how that impacts the building's appreciation over time.
So they can appreciate in a couple of ways. What you have, and you touched on this earlier, we have rent and then we have rent increases. So naturally, as a result of the increase in rent, our property compounds in value over a period of time. And certainly as rent increase 2, 3, 4% a year on a standard schedule, it's 2, 3%, 4% compounded each and every year over a period of time. And on occasion, a tenant moves out and we bring a new tenant in and we realize the market value of whatever's going on in the market right now. So for example, there have been a number of tenants who may have signed a lease 5 or 10 years ago. The rents look very different today. In fact, last year, 2022, apartments had the number one rental increase across all asset classes. Industrial property, the number 2 largest rental rate increase across all asset classes. And so there's significant demand for this, and as a result, increasing rates. Your next question that you asked me was relative to the supply. So let's talk about that. When we buy assets, principally it's assets that are 10 to 25 years old, somewhere in that range. Let's call it a 20-year-old building. Nobody's making a 20-year-old building again, right? You only make new buildings. And what's happened over the course of 20 years is that a building that was built 20 years ago is not being built today. It looks very different. It's much bigger. It's much broader. It's much more expensive. They have to go bigger in order to get it to make sense. And so what happens as a result of that, it makes these older, smaller buildings more valuable because the demand hasn't changed. In fact, the demand has increased. Those big buildings, most of the people who would occupy a building that we would buy 20 to 50,000 square feet, 20 to 75,000, they're not moving into one of the brand new buildings that's say 100 to 500,000 square feet. They will have no need for that. And so they like occupying what we have. And certainly when it comes to, reshoring and the demand for what's taking place there, kind of that sweet spot we live in has tremendous demand. And as a result, it increases the rental rates, thus increasing the value of that property, appreciating.
Yep. This might be oversimplification, but just a reminder that for commercial properties, their value, a large component of that value is their income producing ability. Not like a house where you're comparing it to other properties down the street. A large factor of that building's value for resale, for refinance, is its income producing ability. And so when that income rises, the value of that property rises as well. Okay, we've got 2 more left. Up first is flexibility. So this might be kind of a strange concept for someone to think about, but I'll use multifamily again because we've used that as an example. A multifamily building, by and large, has one purpose, and that is to exist and function as a place for people to live. It's fully set up. You've got bathrooms, kitchens, bedrooms. There's not a lot of ability to turn that into something else unless it's maybe a hotel, but the cost of conversion to say from a hotel into a multifamily is extremely expensive. Mm-hmm. So I want you to talk about how industrial properties have an advantage as an asset class because their use can be so flexible. They absolutely can be flexible.
What comes to mind is, we have tenants inside of our properties that, just imagine a big box, 20,000 square foot box. That's all it is. And then the versatility, the flexibility comes into that. We have tenants who operate a bakery. We have, the largest grocer in the state operates their bakery out of a property of ours. Another tenant sells very heavy equipment, machinery. They do sales and service of very heavy equipment. I have seen inside of industrial property call centers. They just put a little drop ceiling, not a little, they put a significant drop ceiling down and they operate a big call center floor out of it. So the versatility that one can have in that space, all the way from baked goods to sales and service of heavy machinery to just having people, quasi office, it has tremendous flexibility, which allows it to have increased demand because of that flexibility. There's a whole bunch of things that can transpire inside that space.
Yeah, your ability to place a new tenant or new tenants in that building, you have a much wider target audience, to put it that way, than you do in other asset classes, because that building can be repurposed. It can be adjusted much more easily. We took a tour of a property that was a flex space. So it's had some industrial, and then in the back it had basically storage space. And they had turned some of the basically garage doors. They had put the wall back in, and they were trying to refill the space. And so they were going to take that wall back out and put new garage doors in again. And so that's just a great example of how industrial properties can be super flexible. All right, our last one up is lower maintenance costs. So you've mentioned that a lot of industrial properties are just big boxes. And so talk about how that reduces, as an owner, that reduces the maintenance costs that you have to be responsible for.
And I would take it one step further. It's not just the maintenance cost, but it's the risk exposure due to the maintenance costs. So I'll give you an example. I'll contrast this with apartments because that's an easy one. Apartments, if something breaks, the oven breaks, the carpet gets torn up, whatever it may be, there's a plumbing leak. The owner of that property is having to fix that. And taxes increase. Insurance goes up, and whose insurance isn't going up right now? And certainly, if you're in the South in this country and you've got any exposure to hurricanes, you've seen significant increases in insurance. The ownership bears the cost of all of that. They take it all. Versus an industrial property, all of those things I just mentioned are borne on the tenant inside of a triple net lease. All those expenses get pushed to that tenant, and that's agreed to on the contract, on the lease. And that's commonplace inside of a triple net lease. The insurance, the taxes, the ongoing maintenance, the HVAC system, all get pushed to the tenant. And what do we have then? What are we left over with? Again, is our dependability on the income. When we have a lease, and our reliability to know we have steady ongoing income coming in without any sort of surprises. I was just with somebody this weekend, and their insurance costs, for example, they're in the South, so they've got exposure to hurricanes, went up by 90%. 90%. I mean, it's a tremendous increase. And so that means that, they've got to pass it through. They have to eat it, which means their investors are ultimately paying for it's coming out of the returns. We just don't have that exposure inside of a properly structured lease.
Very quickly before we wrap up, why would a tenant want to sign a lease like that where they are responsible for all of those costs? Yeah, no, that's a good question. It has become commonplace inside a big business in the industrial space where that is the standard. It's the gold standard for what's there. I'll give you another example. Who else signs leases like that? Walgreens, CVS, McDonald's. To the extent that when they want something done in their own building, they do it themselves. They are not calling us. It is more important for them to go do it as fast as they can so they can keep business moving. Because the cost of being down, what they have figured out is the cost of being down costs them more than somehow pushing that cost of a fix or a problem onto the landlord. Yep. And so that makes total sense. The same thing is true in industrial. Great. Well, we've talked about lots of the benefits of why industrial real estate might be an interesting asset class to look at more closely. We talked about stable income, lower vacancy rates, global factors. We discussed the pandemic and reshoring that's taking place, diversification, appreciation, flexibility, and lower maintenance costs. So those were just 7 quick items that we wanted to touch on today and give you a real overview of why we think industrial properties are a great asset class. They're the big 7, and that's the reason we specifically invest in the category. So this has been a great conversation. Ava, I'll give you the closing word for the day. The closing word, that's good. Industrial properties are easy to overlook. It's something that we don't really think about. We drive past them all of the time. So I would encourage you, next time you're out in your car, maybe you're walking around, take a look around you. It's easy to identify, retail centers, strip malls, mobile home, multifamily, but take a look for those warehouses. Look for those buildings that have, big steel roofs, and it looks like there's maybe some heavy machinery or other things going on there. And try to imagine what kind of tenant uses those properties, because every item that you own, like my coffee mug, that all has to come from somewhere. It has to get stored. It has to get distributed. It has to get manufactured. Industrial properties are all around us, and it just takes a little more effort to discover where they're at.
They're hidden in plain sight. That's great. It's been a great conversation, Ava. Until next time, see you guys soon. To our listeners, pat yourself on the back. You guys have made it to the end of the show, and most people never finish what they start. If you received value from today's show, be sure to share it on LinkedIn, your Facebook page, or your social media platform of choice. Subscribe to never miss a valuable episode in the future. And if you found value in today's episode, give us a thumbs up with a positive review. If there's a particular topic you'd like to hear about, well, I want to hear from you. Shoot me a message on LinkedIn. The link to my profile is below in the show notes. You can connect with me there for more valuable content.